Hi everyone, welcome to the Stock Hacker channel. I'm Erwin, that's Joel.
What's going
And
on?
what's going on? Market's melting down.
Yes, it is. Yeah.
But they didn't, again, need to get back to the mindset that professional investors have and retail investors, uh, retail investors of oil, for example, people who pump gas into their cars, when they see the price of gas is going down, they're happy. So there's no reason why stock investors, real estate investors should not be happy to see prices going down. Is it great? Yes, it's not. Doesn't feel great that my real estate, my stock portfolio is going down, but professionals have cash on the sidelines, ready to take action on fantastic opportunities. And so that's what we're talking about today. Potential opportunity. Today we're talking about Canadian banks, right, Joel?
Yeah. Big five.
Can you name the big five?
So we got BMO, Bank of Montreal, TD, Toronto Dominion, uh, RBC, Royal Bank of Canada, CIBC, oh God, no, the Canadian Imperial Bank of Commerce, and
You got
Scotiabank.
TD. You got TD.
Yes, I
Right,
said,
right, right.
yeah,
And
TD.
apologize to anyone we're offending that we cut it off at five because a good friend of mine includes his bank, which is National Bank. He
I
says
mean, they are big.
they're one. He says they're one of the big six. Like, okay, I just cut off at five, and it's like we're not discriminating. We'd love to be more inclusive, but we can only talk about so much here.
Well, and that's actually a good point. Like, I don't know where they cut that off because if you look at those banks, they're not all of them are in the top, not even in the top five for market cap. Like a couple of them are, but so I don't know where the term Big Five came from. But whatever, it's what we're
Good
covering.
point. Good point. But we need to draw a line somewhere. So we're talking about banks
Mhm.
today. What were we talking about, Joel?
Today is a perfect example. Market's down $12 today, 3%. We're looking at SPY of 366 at the moment. Like, I don't think too many people thought that we were going to get to this point. We are officially in correction, not sorry, crash territory. We are down 20% from the highs in January. Uh, it's a lot of buzzwords. People are seeing value wiped out from their accounts, and that can be a little unnerving. Not a little, a lot. It can be a lot unnerving, especially if you don't know what's going on and why and what to do about it. So this is what we're trying to solve: what to do about it. Now, you came across a really good blurb, a really good excerpt about uh, the banks and why they're a good idea right now. They listed several points. Remember what those points were?
Well, one of them is I think everyone knows we're in an inflationary environment. Interest rates are going up. So how do you benefit? That's basically how I always operate in life. I take in a piece of information and I wonder about how can I benefit from it. Well, and then also who benefits from it. So, for example, if interest rates are going up, those who lend money can make more money. Can we think of anyone who does that? I've borrowed a lot of money from these people. Right? So that'd be the Canadian banks. I won't name specifically who. Scotia is one of my favorites personally, uh, and uh, I think we all know as Canadians, the banks are very good at taking money from us.
Yeah.
And they report every quarter. They report billions of dollars in profits, and I believe all of them have been raising their dividends. So might this segment of investments be worth looking at? I think so. I think so.
And one of the interesting pieces too is how much is saved up. And I never clicked with that. Like you shared
Good
in one of the
point. Good
iWin
point.
meetings about the how like TD Economics came out with that report. Well, banks have all this cash reserve essentially from deposits.
Hmm.
Um,
And
like that's a
Canadians
good
don't
thing
like
for them.
leave their money in their bank in their mattress. It's in the bank.
Mhm. That's a really good thing. They also talk about house prices benefiting the banks, the rise in house prices. Obviously not right now, but over the last few years anyway. Um, another thing I didn't think about: commodity prices. So
Yes. Canada's got lots of them. Like, I think we underestimate, we don't appreciate as Canadians how much the commodity and oil industry matters for our economy. It's a big
yeah.
deal, and we got lots of them, and the world needs more of them.
Well, and especially with Russia being isolated.
Hmm. Yeah.
So
So fertilizer, Russia and Ukraine being responsible for a large part of the fertilizer exports and wheat exports, uh, the oil exports. Three things we have. I don't know if the word abundance is applies, but These are all things that are available in Canada. So Canada is a bit more insulated than other countries are for these problems.
Yeah. So, and when someone else, like when a foreign entity is investing in Canada, they're going to the biggest financial institutions
Hmm.
to as gateways for lending for whatever. Big five are there.
Right. And our dollar in Canada is devaluing. So I'm actually checking it out now, but I know it's devaluing. The U.S. dollar's been strong this year. Our dollar's been devaluing, which means good for our export economy, which is good for the overall economy.
The dollar is something that I always, for some reason, I never pay attention to, but it really matters. So especially if commodities, people are other entities, other foreign entities are going to rely on Canada for commodities more, and it's becoming cheaper for them to buy Canadian. Like that's a double whammy for us. That's a good double whammy.
Mm-hmm. And the whammy that we didn't complete the thought on was how, like you mentioned, Canadians have more savings than ever,
Sorry.
and then so therefore the banks have more deposits to lend against,
Hmm.
and they can make more money lending in this environment because interest rates are going up.
So some strong points for the Canadian banks. Plus, they've been around for hundreds of years.
Hundreds of years. They pay dividends. They consistently grow their dividends because they're so good at making money from us.
When you're a government regulated institution that the government literally backstops,
Yeah,
it's a hard fail point.
and it's I'm actually just thinking out loud. I might try to own enough bank stocks so that the dividends pay for my banking fees. I think that'd be a first goal to have.
I was thinking about this morning. I was like, I should probably start investing in like some oil ETFs or something,
Yeah,
and
to
like,
pay
but
for
ones
your
that
oil.
specifically, yeah, exactly,
Yeah.
pay my gas bill every friggin'
Yeah,
month.
if the price of gas goes up, you're happy because my
Yeah.
stock's going up. Let's just reverse. Let's just flip the mental mindset over to make a negative a positive.
Exactly. Yeah, man. Got to be able to see it both ways, or else you go crazy.
Joel, you have some charts to show us?
Absolutely. So let's take a look at. I'm just opening up. Just need screen share, right?
You got it.
And what I'll do is we're going to look at the comparison first. And what you're about to see is a bunch of squiggly lines. I'm warning you now, but I'm going to explain it. So hold your horses. All right. So can we see that? Excellent. What we have here is a comparison of the big five to SPY, which is the S&P 500 ETF. Now, this is all on the New York Stock Exchange. I've chosen to do this on the New York Stock Exchange for consistency, and also I personally only trade on the New York Stock Exchange just because I like making American profit, USD profit, but that's a completely different story. The patterns and performance will match and mirror for the most part on the Canadian side. Now, as you can see, all right, so I'll slow down a little bit. This is the 5-year chart. This is the last 5 years of performance. The big green blinking dot is SPY. That is the S&P 500. And so last 5 years, it's up 51%, which is interesting considering how much pain we've seen in the last little while. Still up 51% over the last 5 years. Cool. We have BMO. RY is
Royal Bank.
RBC. Yep. TD, Toronto Dominion. CM is CIBC. Well, BMO, Royal Bank, and TD all kind of fit in that 30% category. CIBC is at 21. Bank of Nova Scotia, that's BNS, it's only at about 2%. So they are still positive even after all the pain over the last 5 years. And BMO, RBC, and TD kind of taking the lead. So here's BMO, $97, and it comes in with right now. And here's the beauty, folks. Usually, dividends on bank stocks, they're not the most amazing dividend in the world. right? They're a balanced, like conservative. They're considered a conservative investment by most, so you're not getting insane yields. But because the prices have dropped and they have consistently raised dividends, right now BMO has a dividend yield of 4.3%. That's pretty good. Usually it's like 2 or 3%, right? Uh, CIBC, their dividend 4.9%. They're sitting at $50, just under $50. So that's an affordable stock in a major Canadian financial institution that's paying almost 5% yield per share annually. Interesting. TD, $66, and we're looking at 3.99% dividend yield. And the reason why I'm highlighting the dividend yield is because if we're looking for, first of all, income and cash flow, if you're a real estate investor coming into this, you understand cash flow. Dividend yield is cash flow. Also, a company's track record of paying out dividends is usually, not always, a sign of safety, or at least good management. Bank of Nova Scotia, $61, just over 5%, almost 5.1% dividend yield. And Royal Bank is $96 with a 4% dividend yield. So you could buy some shares of all of these individually. Not saying you should, this is not a recommendation, but if you investigate further and you like what you see, you could buy some of each. You could just buy one, or the last chart I have for you, XFN. It is an ETF. It's a exchange traded fund of many financial companies, but the big banks are a big part of this holding. $44, and it has a 3.19%. So if you wanted exposure to the greater Canadian financial industry landscape, XFN might be something to investigate further.
Yeah, you couldn't get more boring.
Couldn't get really good.
Which would be lovely these days.
Oh yeah, what I really should have done is like compared losses, but it doesn't matter. We're getting good prices, which means we should be getting good dividend yields, and which for me personally warrants further investigation. That does not mean I'm buying, just means I want to watch these and investigate further.
Right. So Joel and I are saying this isn't advice. Even if it was advice, we're not doing anything today in terms of buying. Today being June 16th, we're gonna wait this out, see where the bottom is, because I think Joel and I both agree that the bottom is still not here yet. But it could be just a few months. I think we're just a few months away.
I think one of the nobody knows where the bottom is. I can't
Nobody
predict
knows.
the bottom.
Nobody.
One of the points that I've been making to people, and we were talking about this a bit before recording, was the fact that if you look at the 5 years leading up to the pandemic, because the pandemic was nuts. The last 2 years were wild in the stock market. So you look at the growth trend, or just the trend in general, which happens to be a growth trend, 5 years leading up to the pandemic. If you keep that line going, we're still in an incredible 5-year trend right now, even with the losses that we're seeing right now. So perspective. I'm going to go over some comparisons between the 5 banks for fundamentals, and then we can wrap it up after that.
Oh, Joe, before we get to that, we mentioned that we're crashing right now. I wish there was a free report on what to do in a crash. Where can people find that?
So before everything went nuts, we were like, what happens if the market crashes in 2022? We literally looked at it and made a report. It's called What Do I Do? What to Do if the market crashes in 2022. We'll have a link in the description below. And it lays out what's happened in previous crashes, the performance since then in those crashes, and some advice like what Warren Buffett talks about. We don't give any buying advice in it, but it prepares you for an eventuality that we've actually slid into now already. So if you want a little bit of illumination there, the link will be in the description below.
And my interest in all this, as well as I'm looking for cash flow. People always taught us in the early days around real estate to do it for cash flow. Not many investors make more than like 4 or 5% cash on cash. So a 4% dividend, 4 or 5% dividend without having tenants is not so bad. And then if you want to be a bit more advanced, then you can write cover calls like we teach in Stock Hacker Academy. And I believe we have another video on that subject as well to amplify your cash returns.
Mm-hmm. 100%. Who wants a bank as a tenant? Like, who would love to have a bank as a tenant?
I think
And
if we were
that's
commercial landlords, I think we'd all be like whining and dining the crap out of these people for banks to be our tenants.
there you go. And you can have them as tenants with your dividends. So that's all for me.
And then one last time, Joel, if people want to learn about what to do if the market crashes, where can they find that?
Link below. It's it's kind of it's a tracking link. So unfortunately, it's not the prettiest. We're going to change that. The what to do if the market crashes in 2022, and it outlines what's happened in the past and some mindset things, how to approach this, the opportunities available, but also the risks. So link below what to do if the market crashes, free report in 2022.
It's funny. It's like we predicted this. All right.
Mm.
Thank you, Joel. Thank you, Joel. Thanks everyone for watching. Like and subscribe. We'll be back next week with more content for your favor.
Thanks, everyone.